This is going to be an important highlight because it brings in all the simplicity of what you're trying to apply in trading, which is what? Trying to predict what the hell's going to happen next. If you're caught in trading in this price action, you're probably what we call getting chopped up all in here, right? Because it isn't really going anywhere and it's just a battle between short time frame longs and shorts duking it out all in here and not really getting it to go anywhere. So the best thing you could do in here, if you're trading that mess, is maybe breaking even. You aren't going to have much to show for it. So you're trying to find moments. First of all, identifying what we call congestion boxes, right? There's a range and a box, and find moments like inside the box where it might have the energy to break out. If you don't know why a market would break out, you're going to have a heck of a time trying to predict it and catch it. Well, why does a market break out when it breaks out? It's because it's a moment where there's enough people on one side that are saying, holy SHIT. What do I mean one side? Well, there's only two sides. There's longs. Wait, I got the wrong size pen here. There's longs and there's shorts as far as positions go. Why the hell's that fading away? All right, there's longs and there's shorts as far as position goes. Longs and shorts, right? If you're let's just go L and S for crying out loud. If you're long, what are you to cover that long position? You're a seller. If you're short, what are you to cover that short position? A buyer. So therein lies what you need for the price of anything to go up or down. If you get many more buyers than sellers, price goes up. If you get many more sellers than buyers, price goes down. Keep it simple. So where is it when you're trying to predict? Hold on. Kashikari is talking. Fed official. If you can identify where those two sides, remember, longs are now sellers and shorts are now buyers, where those two sides are going to get and have their moment where they say, I got to get out or I got to try to get out. And if shorts are trying to get out, then if a lot of shorts are trying to get out, then that's going to bring a lot of buyers to the market. And the market consists of the instrument you're trading, whether it's a stock or futures, oil, gold, whatever. So if buyers are going to rush to the market because shorts are going to start to cover, you're going to be able to predict an upside breakout. So the congestion boxes are important because this is what everybody sees, whether they know it consciously or subconsciously. Like, I don't want to be short if it gets above and breaks out above there. So they put their buy stop, either mental buy stop or actual buy stop above, and then they put their sell stop below where the longs want to cover. I don't want to be short if it gets below this guy and below these swing lows and whatever. And so you start to build a scenario and a story to say where it could get momentum. That's what a breakout is. Hold on. You're not really saying anything of that's consequential. All right. Now, you also had this moment where this had a swing high it could go for the NASDAQ and a congestion box that was built up in here. All right. And then a little one in here. And just trying to say if it's going to go up, and it also broke out of this one earlier. We're trying to predict where this market could get momentum because the worst thing in trading is what? Being long or short and it's just sitting there. Being long and short or it's against you. Those are the two, moments where it sucks worse to have it to be long in prices against you. But it also sucks to be long and it's just right where you got in. When I say it sucks, is because that's not why you got in. You didn't get long and say, I'm going to get long and in 10 minutes it's going to go up. No, you'd wait 10 minutes and then buy it and get long. Why the hell would you buy it and sit with it for 10 minutes? So nobody is expecting the price to just stay where they bought it, opening up that long position for a period of time, or you would have waited. So you're trying to time your entries. You're not going to get perfect at the time it goes up. So you take no heat, it just goes. But that is the definition of a great location. Minimal amount of heat, and it goes your way ASAP, sooner rather than later. So once you start to build the scenario where longs or shorts can get nervous, now you're taking into account real time. And the more real time, the better at real time analysis you are, the better locations your timing is going to be. If you're working on analyzing past data, you're only going to get so good because everybody could see that shit. You got to get good at what's going on in the recent past and then right now. So we build the scenario where there could be an upside breakout because of what I just laid out. But then there's other things that you could stack. There's an ancillary market that's been working for us really well. It's NVIDIA, the stock NVDA, which has been one of the higher weighted stocks in the NASDAQ as an index, but it's also a big mover. And those are the two rules of thumb of watching a stock to influence an index. Number one, does it have a decent weighting in the index? And number two, is it moving? NVIDIA has been doing both. So NVIDIA had a congestion box as well. All right. And I'm going to bring that in. And I think I showed it. I pulled the chart in real time. But right in here is what I was saying. NVIDIA above there is gonna have a good chance to fill this gap and go to where it started at breakout right up there. And it also has these swing highs that it's going to want to get through. So anybody short or anybody wanting to get long, either side are buyers, right? Shorts that got to cover are buyers. People who want to get long are buyers. They could come flooding in above this yellow line. And it's not a hindsight call. It's a market's not doing anything. What's going to get it to do something? And it's a breakout call. Now, I'm not trading NVIDIA, but I'm using it as a major piece of the puzzle to help make predictions as to where the right side, the next right side of the market's going to be. So we pull that aside. It starts to break out. Actually, let me pull this damn thing back over here. It starts to break out where? In here. And before it does this, because after it gets up here, it's a little too late. But it went up 30, 40 cents down in here pretty quickly. Like one ticket was 40, 50 cents higher. The next tick was 20 cents higher. So it wasn't 10, 12, 10, 12. It was bam, had a nice run. But I'm already anticipating it could go up. Then you actually see it go up. So all of a sudden, hey, dark clouds in the sky, it's going to rain. Then it rains. It's not a surprise. And that's the situation. Now, that helps with the ES. If you're an ES trader, NASDAQ trader, help predict that if you just watch this market where my cursor is. Take a look at this. Bam, it goes up. Now it goes up pretty quickly after NVIDIA took off, but you're anticipating a breakout through a congestion box in the ES, along with a similar congestion box in NVIDIA, and a little bit of a rotational top and congestion box here in the NASDAQ. All right. So you've got a chance for this spike to hold. You'd like to be long down in here, right? But you're objectively able to think that the market could continue, especially if NVIDIA starts to continue or the NASDAQ continues if you're long the ES. Let me break it back down to this, though. Right before it popped, we had a bunch of longs turn to a bunch of shorts. The lasers, we call it, went green to red. Boom, right there. You see all those shorts that came in 48 to 13? It was opposite a moment ago. So you start to build the story of where a market's price could start getting momentum and actually drive up or down, where shorts or longs are going to get nervous. In this case, shorts going to get nervous. A correlation or relationship to value the price to create a little lead lag or the ability to more accurately value whether this t-shirt's expensive or not. That's too much. Why do you think this shirt's too much? Because they're selling it at this other store for $10 less. Why is this car price too high? It's the same damn car down the street I can get for less. You don't know that if you don't compare it to something, right? So that compare contrast is a technique. I said this a million times that all consumers have used entire lives, but most people, when they open up a trading account, ignore it. So this, you got to find a good ancillary correlation, but then know how to use it. So, okay, you're building a scenario where shorts might get a little nervous and start create the probability that the upside, probably the right side, and we're going to get this. You also have a bunch of shorts coming in. Ooh, what do you mean shorts? Well, I just said shorts are going to get nervous if you predict shorts are going to get nervous above this line or above this line. And then you get more of them that come in. Why? Because shorts now are buyers. The more buyers that have to come in, the better chance that the probability it's going to go up is going to be fulfilled, right? The more and I'm not a meteorologist, but the more, inputs you could get that it's going to rain start happening, the better your prediction that it's going to rain could be. You know what I mean? So you're getting some things that are already aimed fire. It could seem like it's a lot if this is one of the first times you've heard me talk about it in a video, but when you break it down, it's not. And oh, by the way, you want it to seem like a lot in the beginning, or else everybody else would be able to know it, get it, use it. Most people will listen to this video. It will make logical sense that this is a strategy that has to be part of any winning strategy. The type of tools of following and reading order flow, correlation, creating an opinion from a ready, aim, fire approach. But they still won't follow that path. They won't, like, it could be super obvious and they still won't do it. Someone gave me an example of that with even like an easy, losing weight is hard, but even if there was an easy weight loss path and people knew it, a lot of people wouldn't even bother taking it. They know the answer. They just I think people being people, so to speak. So you're going to need an advantage over your competition. Who's your competition? Other traders. You want blood. You're not going to be successful and consistent unless there's bleeding that's going on. Without any blood, there's no opportunity. All right. And that's the bleeding in this metaphor are losing positions, people stuck in trades. That's why it's important to get a sense of other people's positions. Opportunity comes from the bloodletting in a particular industry. Very, very short time frame. It's this. Too many shorts, buyers coming in, get a head start, because the definition of a good location will always be having price go your way ASAP. That stands for as soon as possible, Carl. Carl, someone been with me a while, but takes them a second or two to understand acronyms and spelling. Either way, that's what we had today. This isn't stuff that is talked about only after. I was telling people keep an eye on it. I was going over with people what to watch with respect to this setup before it happened. And then there was another opportunity, the same thing happening. And this time I think I actually brought the NVIDIA chart over. I did, but I'm fast forwarding it too fast. Let's see. Oh, right, there it is. There it is. All right, see, look. Oh, here, before. So here's the moment I was just talking about where it blasts up and goes up. I'm going to rewind it. And so I did pull the NVIDIA chart up to talk about this before it happened. Where is it? There we go. Come on. There. You see the yellow band I put in here? This is on the recording. Those are the highs I was talking about. And I said, if it gets above there, it was like 90 spot 50, 901. But it's right above 900. There's a good chance that it's going to break out, take out these swing highs over here, and then fill the gap to where? To where it broke out, to where it started. Where did it start breaking out? Right here, about 5-10 minutes after the open. And so it's not hindsight, but it's using something else to help you predict and give you an advantage over what. Come on. Oh, I'm trying to pull this chart off, but it's on the recording. Good luck doing that. So fast forwarding it. When it went, we went. When it went, we went. When it went, we went. And it had a bunch of shorts pile in, especially right there. 57.19, looking at this number right there. And like I said, the best the best definition of a good location is for price to go up as quickly as possible after you put the position on. And even if it's an investment, let's say you're going to buy a home for an investment, be nice after you bought the home that all of a sudden prices in that area went up 10%, right? Wouldn't that be good? You certainly wouldn't want it to go down 10% after you bought it. So even longer time frame ideas and investments, it's always better your timing if your investment's worth more sooner rather than later. If I leave a pawn store and bought a nice piece of jewelry for $400 and later that night someone looked at it and said, I give you 500. Not that I'm looking to sell it for 100, but it went up ASAP. Or a pawn stop dealer, right? They buy a piece of jewelry for 200, if they can get immediately $300 in 10 seconds, their timing was better. And I'm using pawn shops because they're constantly doing that. They're looking at what they have and weighing what something they could get based on what they could sell it for. It's a market. Everything's a market.